Hi guys, welcome to the Savvy Money Show. Me, your host Sean. Now we're gonna get on with the show, and to do that, we're gonna go with Maxar first of all. You'll notice a lot of these companies I've spoken about in the past. Maxar I spoke about when it was $7 a share, and now it has 23% net income margin, and P ratio of 8. This is one I forgot to put in to the space ETF yesterday. I do think it will be in Cathie Wood's space ETF. More or less has a monopoly on its sector, and I think it will be good growth growing company. Speaking about growing company, another one, it's doubled fail. Has a 4% dividend. I think it can still grow. Has a net income margin of 9%. It has total assets versus liabilities of 1.71, and it has free cash flow of 18%. Now, I'm look at AVN, and AVN is 2% dividend, which will be coming up fairly soon, and has an 18% net income margin, 3.4% free cash flow, and a 1.54% total assets versus liabilities. Now we are going to go on to Kcac Systems. It's a 5G growth play which isn't profitable at the moment, but it does have 10% free cash flow, and it is 50 cents below its intrinsic value. Now, if you remember, I spoke a while ago about Purple. When it was below $10 a share, it rose to above 30. Now another one in the industry, Casper Sleep. Why would I go for a loss-making area or a loss-making company? Well, because it's narrowing its losses, and it is basically. So we have a company whose losses are narrowing, who will soon be profitable. Not this year, but I think the year after. And that's when people will take notice. We have a company that specialises in mattresses, which is something people don't cheap out on. And pillows as well. And sheets and all the old bedding. And beds. You have a company that is concentrating on its brains, and a company is 40% held by institutions, and they say if more than 10-15% is held by institutions, you should take notice. And I'm taking notice. Now, people are staying away because it's not profitable, and that is fine. But it's time to get into a company just before it gets profitable. Remember I said about Pinterest? People missed out on Pinterest because the minute it got profitable, it started zooming up, and they missed the boat. And you can see here, look at total liabilities against total assets. Current liabilities covered by current assets, but it's total assets, total liabilities. Total liabilities are more than double. That's last year. You look at this year, the current assets are the same, but current liabilities are brought down a little bit. Total assets are the same. Total liabilities slashed by 350 million. So instead of going into profitability, now remember, if you declare a profit, you have to pay tax on that. What these guys are doing is they're cutting their debt. And that is something I like to see. Company that is cutting their debt is a company that doesn't let their debt get out of control, and is a management team you can rely on. Now, you know the main brands in this area are $300 a share, $400 a share. And I know the price of a share doesn't matter, it's the market cap, but they're about $10 billion market cap. You know, their competitors are $5-10 billion market cap, whereas these ones are 400 million. They report their fourth quarter and full year financial at the end of this month, 24th I think it is something I think people should listen to, and Kcac has upgraded it to buy. Now this that I think will be worth picking up. It's a speculative growth stock. If you were in on purple, when I said getting on purple, I said at $7 and $9, you're more than trebled your money. So take out your initial investment from purple. I can't tell you what to do, but this is what I would do, and what I would do. I'm not telling you to do it. I will be taking out my initial investment from purple, putting it in Casper, or even trimming half of it, and putting it in Casper. And I hear all this about, oh no, only so much of your portfolio in spec stocks. I earmark at the start a certain percentage for spec stocks, a certain percentage, and you know how it goes. But when my spec stock has turned from a spec stock to a growth stock, and I've taken, or when my spec stock has become profitable for me, I would take my initial investment out. I still have that investment to put into a spec stock, because it's still part of my spec stock investment. It's still part of my portfolio earmark for spec stocks. So I don't always, oh, this little penny's got to go to this level. But you have to make your own decision, do your own due diligence. Me, I think this is nearing the turning point. I think if you can afford to hold it for the next couple of years, then it'll be worth. Look at that, Motley Fool, 3 great stocks to buy under $10. That was 2 months ago. And 3 months ago, it should bounce back in 2021. Now, you've had all that growth, but the share price hasn't kind of dictated it. Now, it has only just started moving. If you want to wait for a pullback, wait for a pullback. But to tell the truth, you're getting it in August, July prices, because you had people selling out of it to go into other companies. Anyway, Hope you've enjoyed today's video. Have a nice evening. Enjoy it with your loved ones. I'll see you in the next video.